Okay, we're now recording. Welcome to the beginner training group on Thursday, May 25th. Today is going to be all about butterflies, and we have a guest speaker today, my friend Wayne Klump, who's in the room, and I'll turn it over to him in a few minutes, and he'll talk about how he trades butterflies. But I wanted to do a very quick review, since we talked about butterflies maybe a month ago when we introduced road trip type butterflies. I want to work one up here and just do a quick review before Wayne gets started. So I'm just going to pick a expiration series. We'll just pick June 28th, and I want to work up an at the money butterfly to start with. 21 July. Okay, that'll work. There we go. And normally when we open these kinds, we are buying them, and let's make it 50 points wide. That'd be 23.70 on the downside. Now, this is a standard butterfly, and it's basically at the money because the shorts are very close to the money, and we have essentially equal wings on the top and the bottom. These are the wings out here, and they're equal distance below zero on both sides. At least they should be. Yeah, 1340. Okay. This is traditional butterfly. There are strategies you can use to trade butterflies this way. And most people add a little adjustment to it to make it a little bit more delta neutral, and here's one way that could be done. Basically, I've neutralized the delta within the tent now, so we're flat here, and but it has changed the picture on the upside. Another way of doing butterflies is out of the money. So I'm going to just work one of those up real quick. Let's say we put our top long at 23.70, short at 23.20. If I can find it, there we are, and the bottom at 22.70. Now, this did something wrong. What did I do wrong? 24 or 22, 20? Oh, I'm off by 100 points. Let's fix that. What I meant to do was something like this. Okay, here's another butterfly. If you started this one, it would be out of the money because price is up here. We're outside of the tent, and it has a long way to go to the shorts. You can trade butterflies this way as well. A number of strategies are based off of this kind of thing. Road trip is one example that starts out at least out of the money like this. You can be very successful this way too, as long as you have rules that are built around trading a butterfly that starts out of the tent like this, and that's my whole point here. You can trade any form of butterfly that you want, as long as you have guidelines or rules that you've come up with that have been back tested that allow you to take what you have and work with it. So this strategy can work, and this strategy can work equally well, sometimes better. And that's what I wanted to point out about butterflies. And the last thing I'll say is road trip. I don't want to make an order. I want to make another one. Road trip simply creates a broken wing butterfly by making the top strike be closer to the shorts than the bottom strike. That's all it is. It's still out of the money when we start it, but now you notice that the top wing is higher than the bottom wing, and that's what defines the word broken wing butterfly. Okay, so when we talk about road trip, we're talking about a particular set of rules to trade a butterfly and a particular way of opening the trade and starting it. We've talked about M3, we're talking about a different set of rules that is based on the conditions for the M3. And there's other butterfly strategies that start in the middle, and they have their own set of rules about how those are maintained and managed. Okay, so I wanted to do a quick review of butterflies and then lead into my friend Wayne. Now, I met Wayne back in June at a seminar, and he's a very dynamic and very outgoing guy, and he had the guts to get up in front of the group and let the speaker of the seminar grill him on some particular points related to psychology of trading. And let me tell you, that takes a lot of guts. And Wayne, you should be proud of yourself for that.
Thanks.
Since then, Wayne has moved to the Seattle area. He lives fairly close to me, and he, along with Dave Thomas, my other friend around here, we get together for coffee once a week, maybe more sometimes, and just talk all about trading. So with that, if there are, let me see for questions. Somebody said they can't hear me. Let me ask anybody else, is everybody hearing me okay?
I mean, I definitely can hear you. So I would assume it'd be on one person's computer.
Yeah. Anybody else hear me okay, or hear anything? Eric says sound is good. Okay. Then Taco, who is the one who said, I'm not sure why you couldn't hear me, but I think it's working. So I have a few more people to promote here. There we go. Okay. With that, Wayne, I think I'll turn it over to you and take it away and tell us what you can tell us.
Okay. Yeah, I mean...
Share the screen.
Yeah, I was about to say, you want to throw me the ball and I'll share my screen?
I do. Let me see here. Change role to presenter. Yes. Now you should be able to say share my screen at the top of the page, and then we'll see your screen. We got it.
All right.
Let me just make sure.
So, everything good? You can hear me okay? You can see my screen, right?
I see it, and I'll watch the chat to see if anybody else has any problems.
Perfect.
Okay.
My name's Wayne Klump. Tim was grateful enough to give me a little bit of introduction, and thank you for the compliments. Currently I'm a strategy developer for Blackbird Capital. Some of you guys may know who Ryan Moffat is, but anyways, we started a hedge fund, and we primarily help out and manage money for all sorts of different clients, up and down the list, from normal people to full-fledged traders to extremely wealthy. So, but anyways, I've been with them for a little bit of time now, and so for doing that, I've started developing all sorts of different ways to trade many different things, even other than butterflies. But today, we are definitely going to talk about butterflies in a different way. So I started labeling this presentation as Know Your Risk, and it's something that even as a professional trader, sometimes you lose grasp of, just because you get caught up in maybe the Greeks or what the market's doing or anything. And once you lose track of your risks, you tend to not be around much longer anymore. So, everyone talks about this risk versus reward type mentality, and we're going to get into kind of what it is and where it is and how it's a whole other variable, but it's actually probably the only variable. And so why do I keep on talking about risk and reward? The picture on the left here, Paul Tudor Jones. Picture on the right, Warren Buffett. There's many other traders, Richard Dennis, many other famous traders that all push the same thing. It's risk versus reward. Paul Tudor Jones did it through intraday equity trading, which I'll explain kind of briefly on the next slide. And then Warren Buffett probably doesn't need much of an introduction. He did it through value investing, basically really beaten down companies that had a lot of upside potential, but very little downside because they'd been devalued so far. So what did that mean? Well, that means that if he went long on those stocks, they couldn't go down very much further, but they definitely could go up way more than what he was willing to risk in the trade. Um, so it's all basically the same premise from just different points of views. Well, we're going to talk about how they all apply. So Paul Tudor Jones, we're just going to go over a real quick. I know that we're not directional traders, or even if you are a directional trader, this might be a little review, but I just wanted to show you really what you mean by risk versus reward on a directional basis, and then we're going to get into something a little bit more tailored to options. So this is just an intraday graph of an equity, and say we wanted to say this is our entry timing right here. And the reason why, we've got support, we've got a retest of it, and we think that the market's going to go up, right? So we start out this trade, and what we do is say, okay, I'm willing to go long on this, go upward, and if it comes down more than a point, I'm going to exit this trade, but I'm going to ride it all the way up to 1384. So I'm willing to take a profit of 2 points, of a 2-point swing, versus my 1-point risk. So this is a risk reward, or a reward over risk of 2 to 1. So it puts an edge in your favor, one more. And by the way, I have a propensity to move over certain topics really quickly. And so if anyone, absolutely anyone, has any questions, feel free to interrupt me at any given time, and I can fully explain whatever we're talking about, maybe a little bit better, or slow down a little bit. So this is how a intraday equity trader would view risk reward. Well, if you're trading options, for the majority, unless you're an algorithmic trader, you don't trade intraday. So how does this look for options? Well, first, before we get into that, we have to even talk about why risk reward is important. So it deals with expectancy, whether your trade over the long term is actually going to be profitable or not. And so there are a lot of trading systems out there and a lot of trading styles that trade one trade per month, which is a great way to do things. So I used all of these in 12 trades, and so we will talk about different risk versus rewards and what actually is the most profitable style of trading. So this is just a simple equation, and hopefully it's not too intimidating. Just risk over reward times the expected losses and expected wins equals the actual profit that you're going to make at the end of the day. So just to put this into some scenarios, there are many famous trades out there that win 9 times out of the year and lose 3 times out of the year. That is a very, very, very good options trade if it wins and loses that much. Now, those trades that are 9 to 3 out of the year are normally a 1-to-1 risk reward. Well, what does that mean? Well, that means if you're willing to gain, say, 10% with a risk of 10% loss, that's a 1-to-1, which would leave you at the end of the year at a +6. So that gives you an expected profit at the end of the day. Now, what if you lose sight of your risk reward? Say, when things were really popular back in the day, like condor trading, and this is just a really famous example, so that's the only reason why I talk about it. But condor trading, you would, say, win a lot of times, say 10 times out of the year, and only lose 2 times out of the year. But when you did lose 2 times, those losses were huge losses compared to what you were trying to win. So they had a win ratio of 1 to 5, or a risk-reward ratio of 1 to 5. So if you win 10 times and you lose 2 times out of the whole year, and for every 1 win you get, you can lose 5, you end up not making any money at the end of the year. Absolutely none. And what was so famous about these condors is that at one point in time, they were losing much more than 1 to 5. They were 1 to 10. So now you have a losing trade set up. But people believe that they very much always won. Well, so let's start working down the list here. What if you win 9 times out of 3, same as the first example, and you sometimes lose twice as much as you win? Say maybe you wanted to hold a trade a little bit longer and you thought for sure it was going to be a winner, and you sometimes let them draw down more than what they originally were supposed to. Now you're skewing the risk reward. So instead of a +6 up here, now you're only a +3. You cut your profits in half just by allowing some of these to draw down more than you originally thought. Now, let's start moving in the other aspect. What if we start messing with these 9 to 3s and we get away from some of these high probability trades and say we win 3 times, but we lose 6 times? And I realize that this is not 12. I'm just talking about the general purpose of you're going to lose 3 times out of 6, and you have a 5 to 1. And so for every win that you win more money than you are willing to lose. You get a positive expectancy. Well, now let's trade this into a 12-month trade. What if you, say, win and lose half of the time? So now it's not a high probability trade, but when you do win, you win 5 times as much as you are willing to lose. Now you're +24. So just by skewing your risk reward, you're allowed to lose more trades because of the amount of profit that you're able to make in them. So a lot of people, especially in the income trading world, we tend to look at this, we want to win as much as possible, right? Or even some people want to win as much as possible, but they start losing sight of risk reward. And so they start not making as much money. So this 9 to 3, even though on the surface it looks great that you have a trading system that wins a lot of time, but a +6 is good. Don't get me wrong, it's profitable, but I would much rather have a +24. And I'm okay losing half of the time because that means I can be wrong a lot, actually. So how do we use this? Well, let's start talking about this in terms of options. So at first, we're going to just talk about a normal vertical. What is the risk reward of the vertical? Well, the vertical, if you hold this to expiration, this is where the market is. If you hold this to expiration, we're going to get $650. This probably wins a lot of time because of it being that we have profit potential behind the market, and it's very unlikely for the market to drop all the way down here. And we have full profit potential to the upside of the market as well. But in the event that we do go down into here, we are losing a maximum of $3,150. So that's your win or your reward to loss ratio. Now that's more so of probably the latter of maybe those condor style trades that we were talking about in the example on the other page. That you're going to start getting something like this. You might win 10 times, but when you do lose 2, because you're going to lose so much more than what you normally win, you end up not making money at the end of the year. And that's not okay, because we're all here to make some money. So, well, let's see if we can start skewing some things. Well, what if we don't have just total profit potential to the upside? What if we close it off and put another vertical back here? Now this looks like something more like a condor. This is exactly what I was talking about now. But we still haven't achieved even a 1-to-1 risk-to ratio. We have a 1350 and a 2600, which is closer. It's not as bad as this trade over here, but still definitely not to our liking if you're trying to trade options all the way till expiration. We will get into something a little bit further than holding options to expiration. So out of these two, which one's really the better option? Well, no pun intended. Well, with the data that I gave you on the last page, you probably think that this one's still a better trade. But you got to watch out, because now you have closed upside potential. So you're decreasing your probability. And how much are you decreasing your probability for the amount of money that you're attempting to make? Well, that's when you start getting into what is commonly referred to as a butterfly. So now the butterfly, the true power potential in a butterfly is far more than the power potential of a condor. Now, why is that? Well, that's because you have a peak. Now, you might sit there and say, well, what are the odds of ever getting to this peak? Well, that's true too. Which is why a lot of traders don't trade all the way to expiration, because the chances of getting that is like hitting the lottery. But it does happen. Now, but on true risk reward on expiration graph, we're going to talk about a 4,500 win to a loss of 2,500. So you have the potential to make significantly more than what you're willing to risk. Now you have risks on both sides of the market, so what's the probability? You got a lot of variables in here. So if you got a lot of variables in here, where are your true risk rewards? What's the expectancy of this? Well, unfortunately and fortunately, the only way to know if any kind of trading system or style or algorithm that you propose is going to be profitable over time. So say you just want to trade a flat butterfly, just like this, in the market, you want to hold it to expiration, and you never want to look at your P&L, you just want to let it go. And is it profitable over time? The only way to know is to test it through historical data. Of course, historical data does not always imply future data, but it does give you a good idea of what it's going to act like. And over time, this trade most likely will break even. Well, why is that? Well, because sometimes options are priced in your favor, sometimes they're not. Because the value of this butterfly is priced into the statistical movement of the market underneath it. And I won't go too crazy into all of the statistics because we're just trying to look at some of the basics and actually how we can apply risk reward to options and butterflies in general. Well, I do not trade butterflies all the way to expiration. I tend to want to skew the risk reward in my favor even more so than what this is. Well, how do you do that? Well, the amazing thing about options and the fact that they mature gives you an edge. Well, what is the edge that I'm talking about? Well, if I don't want to hold it all the way to expiration, by the way, if you're not familiar with this graphing analytical software, this is option view. I'm not trying to advertise them or anything like that, but let me just go over this page really quick. This line is probably what you're familiar with looking. This is an expiration line of the butterfly. This dotted line right here is the value of that option if it were to be moving today. So if this is the market right here and it were to move up to 14.15, you would be at a loss of roughly $2,900. If it were to move all the way down to 13.46, you'd be just below break even. So this is this graph. Now this dashed line up here is if we were to project out 30 days into the future. This is as a lot of people, income trading or theta trading. So what happens over time is that these short options that you sell decay in value, and they decay in value faster than the longs up here, which give you the ability to buy them back for a cheaper value than what you sold them at. Basically, you're selling high and buying low, which is making money in the stock market 101, right? Well, how do you trade this if you don't want to hold it all the way to expiration? Well, say that I'm willing to hold it 30 days out in the future. Well, if I'm willing to hold it 30 days out in the future, and I want a 1-to-1 risk reward, basically, I'm not accepting anything more than a drawdown of what I'm able to make within those 30 days. Where would that look like? Well, I drew red lines on here that show that. These red lines represent where the drawdown is matched to the amount of profit that I can make in this trade at a future date. Excuse me. Well, say I don't want to do a 1-to-1 ratio. Say we want to do a 2-to-1 ratio because maybe I lose more often than I win. Well, if you want to do that, then you have to not allow this to draw down more than these green lines. So this trade is a perfectly good trade if you want to put it on immediately. But if the market goes up beyond on the value of this asset, if it goes up beyond 14.02, you would have to do something with this trade. Well, we'll get into what you'd have to do with this trade later. Or you just can't be in this trade at all anymore because it's further than your risk reward is willing to accept. Now, as the trade matures, your risk reward becomes better and it becomes in your favor. But that's not what we're going to talk about right now. We're only talking about at entry. If you want an even better risk reward, you'd go to 3-to-1, which if you notice, these lines do not move in very far at all. Tim, did you say something?
So what is the profit target?
Oh, I'm sorry, what was that?
Here's Eric. What's the profit target?
Well,
Or it's irrelevant. I don't know.
yeah, I personally don't use profit targets. I personally use, well, first of all, I'm not here today to teach you necessarily a system. I just want to go over the concepts of how I view butterflies and how I view trading in general and how I've applied that to options. And then you can take a style of system or any trade that you want to trade, whether it be a condor, whether it be a butterfly, whether it be a long call. You can take that and apply these principles to that and significantly augment your trading to give you a better edge than you had. As far as the profit targets that go in my style of trading, I don't use them. I believe in letting your winners run, which is something that Richard Dennis actually said the same thing. So what I care about is not necessarily the profit target, because the profit is not in your control. I know a lot of people view profit as first. They want to look at, well, how much is my potential to make in this trade? Well, that's only one side of the equation, though. You want to know, what are you able to make with the amount of risk that you're going to put out there. So what I'm saying in this is, if your trading system, or this trade in general, is historically wins 9 times and 3 losses throughout a year, say this style of butterfly, an at the money butterfly, 52 days out from expiration, well, if it wins 9 times and loses 3 times, it'd be okay if you use a 1-to-1 risk-reward ratio. So that would mean that you can allow the market to move all the way to these red lines, back and forth. You don't care what it does in between here. It doesn't bother you at all. Will your profit and loss swing around? Well, of course. But you should never draw down on the trade more than you originally planned, because as time progresses, your profits come in. So you might go from a profit of, just in this trade, a profit of $6,000 and draw all the way down to $3,000, or even all the way down here to $2,000. But you shouldn't take a loss on this, because this was where you were willing to draw the line in the sand at the first day you entered the trade. That was how much money you're willing to risk, is $1,500 to win $1,500. Over here, this is probably $1,200 to $1,200. So profit targets that you're asking for, depending on what the market does underneath the trade, is going to depend on what the profit does. But the profit isn't in your control, it's in the market's control. And
okay, you put in relation the T plus 0 line and the T plus 30 line.
Uh-huh.
Okay, great. Got it. Thank you.
Yeah. So with that relationship, if I'm willing to hold this trade for 30 days, that's what my original trade parameters were, this is where I would accept it. Now, what about adjustments? What about a trade that looks more familiar? What about an out-of-the-money butterfly? Say you wanted to put this trade on in the beginning, and say you had a 2-to-1 ratio goal. So you know that this trade tends to win 9 times, 3 losses, and you want to go a 2-to-1 ratio. Obviously, you would have really good expectancy. That's a good trade to have. But when does this get out of those parameters? Well, back here, you'd notice that at 1332, you're going to have a problem, and here at 1416, you're going to have a problem. Because then now your drawdown, even though you might have decent Greeks, or you might have okay Vega, or your Gamma's under control. These are all the Greeks down here, by the way. But you're willing to, you're risking all of this drawdown for no profit potential in it at all. If you're an income trader, if you're just trying to get theta, and you're just trying to get the decay of these options. Now back here, that changes, because over time, the profit potential in here is far greater than up here. So you can tell that just by putting the options back further from the money, that this is where your biggest profit potential is, not necessarily up here. Now you can still make small wins up here, but it creates it creates a situation where you have to adjust this thing, or you have to start lifting this expiration line so that you can start skewing the risk up here, because this is no longer going to be a profitable trade to the upside. So if I'm willing to trade a broken wing butterfly, or this is when you break one leg, or you have a call underneath it, however you want to flatten out your deltas or your Greeks here and get them under control to where you're not taking so much directional risk, you have to start creating adjustment plans. If you're going to adjust, you have to do it, for me, I have to do it in a way that obeys the risk-reward parameters that I'm going to put in place in the beginning of the trade. Is there any questions so far? I feel like I'm hauling butt through this. Oh, okay. So, okay. So from here, could I go through? Could you go through the calculations for the risk versus reward numbers? Yeah, of course. Before I start getting into this, it's probably better that I go back to that. So let's go back to the calculations and risk rewards. The risk reward isn't as important as the total of what you're actually trying to get. So on this, any of these numbers, the greater the number, the greater the profit potential. So if you have a greater number over here, that's your profit at the end of the day for every dollar that you're willing to lose. So in a trade that wins 9 times, basically the butterfly trade that I was showing you as just an example, if you test that over the last, say, 10 years, holding it 30 days to expiration, starting it at 10 points behind the money or something like that, in all situations, it wins 9 times and it loses 3 times. And the way that it does that is it has a risk-reward ratio, or I'm willing to let it draw down as much as it has the potential to make in those 30 days. And that's where you get your risk-reward ratio. So in the example of this butterfly, before any adjustments, before I'm willing to exit this trade or anything, I am okay as long as it doesn't draw down past these red lines. And the reason why I'm putting these red lines where they are is because the drawdown right here, this line, this dotted line, is the same drawdown as the amount that it's able to make within those same 30 days. Now this is today's line, this is 30 days line. And if I'm willing to hold this for the next 30 days, as long as I don't break over this, this is still a good trade, all back here. Now, as time goes on, this line turns into this line, which is where you get your risk reward from. So if you're willing to take a 1-to-1, this is what you would be looking at, as long as you had 9 wins and 3 losses throughout the entire year. You're profitable by $6 for every dollar that you risk. Now, I skew these into a better favor, which is about a 1-to-1 win-loss. So for every trade that I win, I lose one. About 50% of the time, I'm kicking myself in the butt and saying, you lost a trade. And it's okay, because that's the odds that I'm willing to take. But if you are willing to take those, you have to skew your risk. So if you were to take one loss for every one gain, and you were to still have a 1-to-1 ratio, you'd end up not making any money. Because for every one you're willing to lose, you're willing to lose, and now you're just spinning your wheels and not going anywhere. So if you're going to use a lower probability strategy that doesn't win as often, you have to start skewing the risk reward. Now, the best situation on earth would be having a 5-to-1 with a 9-to-3, and you just make a fortune, and we'll call you the next Warren Buffett. But it's a little bit hard to get a 9-to-3 with a 5-to-1, even with options. Trust me. So if you take your wins and you multiply them by your profit potential, and then you take your losses and you multiply them by your losing potential, the net over it will give you your profits at the end. So if you take a 9 wins times 1, that's 9, 3 losses times 1, that's 3, you get a +6 at the end of the year. So that's a good expectancy. That's a positive expectancy. At least you know your trade is profitable. But if you take this scenario where you win 10 times and you lose 2 times, even though it's a great probability trade, the fact that you can lose 5 times more than you can make on any one trade, if you take 10 times 1, that's 10, 2 times 5, that's 10, that's 10 over 10, you're spinning your wheels at the end of the year. And so that's what I was meaning by expectancy and the importance of having your risk reward at the forefront of your head. So some people might be familiar with an M3. And yet again, I'm not trying to advertise any specific, it's trading style. There's many good trading strategies out there. But an M3 has about 9 wins, 3 losses every year. Sometimes a little bit better, sometimes a little bit worse, especially depending on how you trade it. And it's willing to lose $10,000, and it has the potential to make $10,000. Now the only issue with an M3 is some people will, once they get about, say 5% profit in the trade, they will bail, because they get scared of letting the profit go up better or higher, because they're not willing to take the losses. I mean, what if that turns into a loss? Well, now you're starting to skew with your risk reward, because now it's not a 1-to-1. Now it's a 0.5-to-1, because in those bad trades, you're going to hold them all the way down to your max loss, which is $10,000. So now you're starting to win half, or 0.5 for every one. Well, now if you take 9 times 0.5, you only get 4.5, and 3 times 1, you get 3. You start really significantly cutting your profit potential, and you're almost break even. And it's almost not even worth trading, because you're only 1.5 for every dollar you're willing to risk, and you're putting a lot of time, effort, everything in it. So it's very important for you to obey your risk rewards and not allow your trades to draw down more than you're trying to win, and you don't cut your profits early as well. Did that clarify things a little bit?
So Wayne, I have a question before. Oh, I see Tom just replied. Well, anyway, my question or point is, if we decide that we have a max loss number, where if you reach that, you close the trade,
Uh-huh.
and we have come up with some way of saying our profit target, and if those two are equal, then we're having essentially a 1-to-1 reward to risk ratio, right?
Yeah. Yeah.
And
now, I mean, if you're using a profit target, then yes.
yeah, and so then the only way that works on a long-term consistency basis is if you win more than you lose.
Absolutely.
Is that right? Okay. I was thinking of like road trip where we might have 10 or 11 wins to 1 or 2 losses, but we have a 1-to-1 ratio, so I haven't done the math, but that probably comes out positive.
Oh, yeah. I mean, it's definitely a positive expectancy because, I mean, if you do 10 wins, 2 losses, then you're a 1-to-1. 10 times 1 is 10, and then you lose 2 times, 2 times 1, so you're plus 8. I mean, that's a good expectancy. That's probably a very profitable trade over time.
Yeah. Okay.
As long as you take them all the way to profit potential. What tends to happen, and I won't get too heavy into the psychology of things, but what tends to happen is with traders that are just starting out or that don't have very good emotional control is the trade will draw down, and then you're going to sit there and I can win this, I can do something, I can adjust this, and it can come back, and you have this hope, right? Which hope is not a bad thing, don't get me wrong. I mean, hope's a good characteristic to have. But that hope will allow you to draw down more than your original trade parameters allowed. And you're going to start skewing with these risk rewards, and in the long term, it's a losing battle if you're allowing them to draw down more, because eventually you're just going to have to say, it didn't make it, and so you're going to bail on the trade at, when the pain just gets too much.
Yeah.
And then sometimes those same traders, and this is just, you're going to catch both edges of the knife, is that sometimes those traders will finally get a profitable trade. Oh, yes, finally. But the market's starting to move around a lot, and oh no, what's going on? And then, well, I don't want to lose what I've got, and I know this is a good trade, bail. And so they bail at, instead of doing, a 10% win, they're only doing like a 3% win. And if you bail at 3%, and you're allowing these drawdowns to take you all the way down to, say, 15%, I mean, you have to win almost every trade in order for you to make money.
Yeah. Oh, which is a great reason not to exit too early.
Right. Definitely don't exit too early, and definitely don't let your trades draw down further than what you're planning, or at least what your system was designed for. And the systems that road trip, M3, raw, Jeep trade. I mean, there's all sorts of different names of trades that we put out there, but each one of these were exactly tailored to their specific risk rewards. And then but then why do some people lose over time with this? Well, the reason why they lose over time is because they're letting it draw down too far, or they're taking bigger losses than winning, or they're not letting it move and breathe as much as what it's supposed to within the trade. So if you start correcting your risk, or say your deltas or your vegas or whatever, if you start adjusting those prematurely or early, you're starting to mess with the very tailored trade, and you're skewing your risk rewards even in the middle of the trade, and that's not how they were designed. And so you'll start to lose money, and that's why sometimes they're sensitive. Now, a very, very good trade that was designed well should be extremely robust, that can handle a lot of mistakes and tweakings, because the market doesn't move the exact same way over it did the last 10 years. 5 years ago we would have said, well, volatility always goes down when the market goes up, but that's not the case. Sometimes volatility is going up while the market's going up. Freaking inversion. Now, someone asked, I saw here, please do the last two on the list. Well, this was just showing. This is a 9 trade, which it doesn't go along with these 12. So I'll just do this one right here because this is still 12 trades. So if you do a trade once a month and you do it for all year long, and your trade that you designed wins 5 times more than what it loses. Well, when you win those 6 times, 6 times 5, 30, and then you lose 6 times, but you're only willing to risk $1 for every one that you're willing to make. So 6 times 1 is 6, so you get a positive net expectancy of 24. So I was showing this in contrast because this last one is more in line of how I trade. Now, emotionally, there are many people out there that can't handle losing every other trade because it's a lot of back and forth. And sometimes these 6 losses are 6 times in a row. And then you get 6 wins in a row, or you get 6 losses in a row, then 3 wins, then another loss, then 3 more wins. It doesn't come in just these nice, smooth one-to-ones, so it's hard emotionally. I mean, taking 6 losses in a row, that's 6 months of no income. I got a request for a Notion request. Do you know what that is, Tim?
No, I don't. I'm not sure. I didn't see that in the chat. It must have come privately to you, but and we don't see that on your screen. We see a gray area.
Okay. Yeah. It's just you cannot control shared content and stop nothing. I'm going to decline it for now so that I can just move on, since we don't know what that is.
Yeah.
But the emotional hurdles that you have to deal with a one-to-one are difficult, and that's why a lot of systems that are designed for new traders and maybe medium traders or relatively new options traders will design something that definitely wins more often because it's emotionally easier. And also your equity curve is significantly smoother because it doesn't have these dips of up, down, up, down, up, down, up, down, up, down, as you're making your money. Now, you look back at the end of the year and you go, man, I wish I would have done that. But emotionally, could you even handled it? Could you have held them all the way to 5? And could you have really cut them out at 1? And so that's what starts messing with things. But this is a perfect contrast between the 2 different styles of trading that are out there. This is someone that trades more so in line with a intraday equity trader like Paul Tudor Jones, what I was showing on the beginning graph here. So if you're directional and you're willing to hold this all the way up to here, then you're willing to take 2 points for the 1 point that you originally were planning for. So you can make 10 of these trades and lose half of them, but since you're willing to take 2 points for every 1 point that you're willing to lose, you'll still be profitable at the end of the day. And you're only making half of the time. You know, just because, you know, if you say we trade 10 of these per day, and you're willing to take 2 points, 10 times 2 is 20, and you're willing to risk 1 point, but you lose half the time. Oh my gosh, I think I messed up on this math here. 10 by 1, that's 10, that's 20, thank you, so it's 10. So you're still net positive 10, which is great. That means you're profitable at the end of the day, and you're only right half the time. That's not bad. So hopefully I cleared up risk reward, and then I know I saw a question back there about, so basically how am I, you know, trading? Well, just like how I was explaining in the intraday trade, because time is the reward that we're trying to get, not necessarily direction. The time value is what I care about. So if I'm willing to hold this for 30 days, so not taking into account direction, because you're not trying to take directional risk, because you're not trying to take a directional shot, all you're sitting here saying is, I'm going to put on a trade that 30 days later has a higher value than what it does today, and how much am I willing to draw down for it for the expectancy that it has? Well, I know by a ton of work that this trade in this volatility environment, and I'm trying not to get too advanced here because I don't know what you talked about, Tim, but I know that this butterfly has an expectancy at a 1-to-1 ratio of winning 10 times and losing 2 times in this environment. Well, but in a different environment, it might have a different scenario, and so you might want it to only draw down 3-to-1, and you're not willing to let it draw down out here because you're trying to get a higher percentage, depending on the probabilities of the trade. I feel like I really confused that one, so I apologize.
Well, no, I think you're saying that just depending on the environment, which, speaking to volatility, you just need to adjust your targets and your risk-reward ratio.
Right, exactly. Depending on you know, how long you're trying to hold the trade, and on top of that, what's really nice about this trade is as you stay in this, that's the beauty of options trading. As you stay in this trade, it becomes safer and safer at your risk-reward points. So at the first day that you put this trade on, it is as risky as it's ever going to be, because you have a probable loss of all the way down to, you know, say 1500, and back here at 1200. So this is the possibility that you're willing to take on the first day, and you've only got a very, very small amount of profit potential in this. That's all you got. The first day is the riskiest day in a trade ever. But then, as it goes by, this line starts to match up with this line. And so now at the same points, at the 1-to-1s, now they have less of a drawdown. So say half the time goes by, 15 days. Well, at 15 days, this would probably be break even right here. And back here, this would probably break even as well. So now, at 15 days in, your exit targets that you're willing to exit on are break-even trades now. You technically don't, I mean, I realize that you still have money in the market, but according to your trade parameters, you technically don't have any loss in the trade. Now, you might have profit drawdown, especially if you're in the middle here. So you would have a profit drawdown of all the way to there. But you don't actually have a loss on the trade itself until it breaks out beyond those lines. Does that make sense?
Yeah.
Okay.
At least, yeah.
Huh? What was
I
that?
think that if we were going to get into volatility and some of the reasons for that, probably another 5 sessions. No, but anyway, We may go there, but we haven't talked about volatility yet.
Right. And I definitely don't want to just like shoot right over the top of everyone. But I just wanted to show that how I view trades different than just someone that looks at, say, Greeks. Because you can make a trade. You can make a trade that has flat Greeks and is beautiful and it looks amazing, but it doesn't have any profit potential in it.
Right.
You know, so it's and the reason why it doesn't have any profit because over time it's not actually gaining what you need out of it. So and obviously there are other variables in there that we won't get into because it starts to get complex, but you definitely want to always pay attention to what you're willing to win in a trade and what you're willing to lose in a trade. You know, as an example, so here's your traditional broken wing butterfly behind the market. I'm sure this looks relatively familiar. I don't know what you've gone over, Tim. But, well, where would you want to do something in this trade? Well, you know, the systems that some people tell you to say, hey, you know, make sure you adjust, blah, 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 or whatever. The reason why they're doing that is because the risk to the downside or the risk to the upside is greater than the amount of profit potential that the trade even has. So, and then of course there's some statistical curve fitting in here, but I won't go into that. So to the upside, and the upside is easier to deal with than the downside, but to the upside, where do you start losing a 2-to-1 risk-reward ratio? Well, it'd be at this blue line right here. So your drawdown is going to be more than 2 times for profit for its drawdown. So you want to do something with this trade at that point, and vice versa. Coming back to the back, you have a drawdown right here of $1,500 and a profit potential of $3,000 or $2,000 and $3,500, but that's your 2-to-1 risk-reward ratio. So you would want to do something back here as well. Now, what do? Well, you can do lots of different things, and I don't want to, you know, teach you a new system or a different way of trading or you know, multiple different ways of adjusting because there's tons out there, and I could probably spend another 20 sessions on different styles of adjustments and pros and cons of those. But this was your original trade that we set up, and we wanted a 2-to-1, which 1416, 1332, this looks all familiar. We'll say the market goes up, you know, and you want to do something about that, and you need to skew your risk reward. So you can add a butterfly up here. So that some people would call this an adjustment. Kind of starts looking like a rhino, but you know, a rhino horn. But what ends up happening is all you're doing, all the trade system is actually doing is it's taking this trade that has no potential for profit up here, and it's putting some potential profit up there. So now instead of your 2-to-1 being at 1416, your 2-to-1 is now at 1426. But you definitely need to look at it as a whole new trade, because this trade is gone. This is your new trade. Where's your new risk rewards? Well, if you haven't drawn down, then your new risk rewards would be 1426 and 1350, which is different than the original 1332 and 1416. And those are your new adjustment spots. So now if the market comes back down here at 1350, you're going to need to do something about it. Now, what happens if you start getting profit potential in here? Or not profit potential, but you actually have profit in it because time goes by and now you're up here. Well, your still original adjustment parameters are hold true because you know that there's not as much profit potential. So, because this is your trade. This dashed line is as long as you're willing to hold the trade for. So no matter what, that's the end goal. So you got to do something at that point. And if you are going to do something at that point, you need to wipe out the whole trade, put something on to adjust your trades, and look at it as a whole new trade. And if you're unable to get the risk reward parameters that you're comfortable with for staying in the trade longer, then you need to exit that trade and start a whole new trade. And that's how I trade. If there's not a way to retain my risk reward ratios, I'll exit and I'll put a whole new trade on that starts with all new risk reward parameters for the current environment.
Mm-hmm. This is why I think I've said in this group, but I always say to people, if you do something like add a butterfly on the top, it changes the dynamics of the trade, and you need to know that doing that has been back tested to produce a positive expectancy. And now you need to know how to manage this new trade because you've changed the dynamics. You know, a lot of people sometimes will call me up and they've suddenly learned about maybe, well, just pick calendars, and they say, cool, I can put a calendar spread on the top and you know, make it look good. But you need to be sure that with those new dynamics that your guidelines accommodate a trade that will still have positive expectancy, and that means a lot of backtesting and a lot of development.
Yeah, very, very true. You know, I see people throw a calendar out in front, and a calendar out in front is not a bad trade in certain environments. In certain environments, it's probably one of the best trades you could put on.
Yep.
But in other environments, it's probably the worst thing because what's going to end up happening is the analytical software that you're using, whether it be Thinkorswim, whether it be OptionView, O&E, you know, whatever analytical software you made it at home, it's not going to take into account all of the variables perfectly. So you can't trust the T+0 line, even though it says, oh no, it's not. Well, it's only going to drop this much going up here. Especially when you put a calendar on, now you threw another variable in the mix. Now it's not direction and time and volatility. You have direction, time, volatility, and term structure. So you got to know how that extra variable changes changes the strategy. And a lot of people don't test them out thoroughly enough to know how it's going to affect everything.
Right.
And you said it perfectly. I mean, you know, a calendar was a beautiful example, but it goes back to even a vertical. You know, as time goes by, that vertical that, you know, say you're going to sell a vertical or buy a vertical back here, sell a vertical, sorry. If you're going to sell a vertical back here, as time goes on, that vertical has less and less power, and you're going to be risking significantly more to make your adjustment, and it's not going to behoove you to do that. So you need to think of something different because the environment's changed.
Well, we should probably try to wrap up here, Wayne, because I try to keep these to about an hour. But Ray, I think, has asked a good question out there. There you go. Is it okay if people contact you, Wayne?
Of course. Yeah, I mean, you can email me anytime. I'm willing to talk shop or anything like that. Of course, you can contact me through Tim. If you don't want to contact me directly, why I've only been able to tread water rather than gain net liquidity on my options. Yeah. Yeah, I mean, risk reward is everything when it comes down to everything. I don't know if you want to read any of these comments off, Tim.
Yeah, but that last one is a very good one. If the risk reward is too high, or you can win 12.8 out of 13 trades and still have negative expectancy, and that's what a lot of people see. And I guess I would add, a lot of times somebody will come up with the XYZ strategy, and it's really hot, and they've got a good record and everything, but a lot of times they haven't been tested out for expectancy or risk reward or long-term consistency, all the same thing. And so
Right.
people will go try to trade these things, and they win one, and then they'll have a big loss, and after 6 months they've got a net negative return, and they don't know what happened, right? Because it was supposed to be a hot strategy. So I guess I'm saying when you choose your strategies, it's always nice if you choose one that has been thoroughly tested and evaluated for expectancy.
Yep, exactly. And if you're not going to test it yourself, you're 100% putting the trust in whatever strategy you're buying. So you better be able to get the data, at least that shows that it has been, traded for a while, or that it's been tested in a way that the expectancy and that it has all the variables into account.
Yeah.
I mean, that's like, there's a trade out there that, I'm not going to put names or anything like that, but, there's a trade system out there that utilizes a very large condor structure behind the market, and what some people don't realize is that it makes a little bit of money, and makes a little bit of money, but in a really bad environment like 2008 or flash crash situations or something like that, the drawdown is significantly more than what you anticipate or what was tested or what was advertised, and then you think it's broken, and then you run away from the strategy. So
Yeah. Okay, well, I think we'll stop here. Thank you very much, Wayne, for coming on. If you're willing, I would be happy to have you on again, and we'll go forward from here.
Yeah. Thank you so much, Tim. I very much appreciate it. Hopefully, everyone got something from today. And if you got any further questions, either contact Tim if you don't want to watch the recording again from my email address. Ask away, or and if Tim wants to bring me on for a different situation, I'd be more than happy to teach you something different too.
Okay. Well, thanks, Wayne, and thanks everybody for tuning in, and to those who watch it later. And we'll see you all next week.